I'm joined by Chris Constant, President and CEO of Getty Realty. Chris, you've been CEO now for about a year. Can you talk a little bit about the progress that you've made in repositioning Getty's portfolio?
Sure. We've made a significant amount of progress this year. The progress can be addressed in three baskets. We continue to reduce the number of transitional properties we have, and when we say transitional, we mean properties we're looking to lease, sell, or redevelop. So that basket of properties is down 20% year to date, and we've got plans to address the remainder. We continue to expand our tenant base and our geographic reach. The best example of that is the acquisition we did last year, which expanded our presence in California and added Portland, Seattle, and Denver to our portfolio. And the most recent example for us is we're continuing to redevelop certain properties that we own in attractive markets. And thus far this year, we've signed 12 leases for redevelopment projects.
What about your portfolio of convenience stores? How are those tenants adapting to consumer demands?
The convenience store sector has changed tremendously over the last 5 to 10 years. As consumers continue to place more of a premium on convenience, our operators, our tenants have had to adapt their offering to meet those demands. So today, convenience stores are part convenience, part quick serve restaurant, part bank, part drugstore. So the sector has grown significantly. If you look at convenience store sales over the last 10 years, I think excluding gas, they're up 6% annually. And the margins on convenience products are very, very stable. They average about 35%.
How much potential are you finding in alternative uses for properties in the portfolio?
A significant amount. So when we think about opportunities to develop in our portfolio, we think about it in two categories. We think about sites that are existing C&G sites that could be developed into new to industry C&G, so larger store formats to embrace that the acceptance of convenience that we talked about. And then we also see a lot of demand for well-located retail sites for non-gas standalone retail uses. So as I talked about earlier, we've got 12 leases and we've got a program going where we're looking to add to that and lease out and invest money in our existing properties for sites that are ripe for a non-gas standalone retail use.
Now let's take a broader look really quickly. What are your expectations for the U.S. economy in 2017?
Post-election, there's certainly some uncertainty, but our business is really driven by the consumer, and I think the consumer in the United States looks good. Our miles driven are up, consumer spending is up, job growth is up, and unemployment is relatively stable. So from our side of the fence, in terms of needing the consumer to drive and to spend money at the stores, we feel pretty good about where the economy is heading.
Well, thank you so much for your time, Chris.
Thank you.
And for more on this and other real estate news and analysis, be sure to visit REIT.com.